Welcome to This Week in Money. I'm Phil Mackesy. Today, David Morgan on silver, Paul Van Eeden on mining, and Ross Clark wraps up the week for you. We begin with David Morgan right after this.
It's all about money at the HowStreet.com Money Expo 2012. See Silver Guru David Morgan, Ross Clark on technical analysis, Keith Schaefer on oil and gas. Also video with Sean Broderick on small caps, money manager Danielle Park, and Dr. Doom Mark Faber interviewed by Danielle Park. Plus visit with industry exhibitors. The HowStreet.com Money Expo 2012 at the Coast Capri Hotel in Kelowna, Saturday, April 21st. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca or at the door. It's all about money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
David Morgan is our guest. He is an expert on the silver market. You can find him at silverinvestor.com, home of the Morgan Report. David is at Money Expo, Saturday, April 21st at the Coast Capri in Kelowna. You can register now at moneyexpo.ca. Don't forget, Dave's also at the World Resource Investment Conference. That's in Vancouver, first week of June. Information there at cambridgehouse.com. David, always great to have you back on This Week in Money.
Phil, it's always a pleasure to be with you. Thanks.
Terrific video over at silverinvestor.com. It's a speech you gave at the California Resource Investment Conference a little while ago down in Palm Springs. Myths and misinformation in the silver market. Let's start with some of the most persistent myths that you keep hearing time and time again.
Well, I think my favorite, and that's, on the video, so I won't spend a lot of time, is silver is not money. And, we could debate that for hours. Mm-hmm. Basically, most of the world perceives silver as money still. But North America, so the U.S. is roughly 5% of the world's population, and Canada is roughly 1/10 of the population of the U.S., so you got about 1% of the world's population. So that's about 6% of the world has been brainwashed into believing that silver isn't money. But any Latin-based language type like France or Spain or most of the South American countries or whatever, the word for silver and money is synonymous, so they see it differently. And is silver just money? Of course not. It's certainly a very high industrial component, roughly 50% or actually a little more than that, of the use of silver is in industrial applications. But that's one. Another one is one I just did a small video on that I'm probably going to make a big deal out of, but you can find it on our YouTube channel. Just go to Silver Guru on YouTube. And it's another myth that is, this one's more into interpretation. You could make an argument that the money thing is as well. But it's about the bulkiness of silver. And what I discovered just kind of, right in front of me, overlooking the obvious, was I keep a kilo bar of silver on my desk.
Okay.
And one day it kind of struck me that the kilo bar of silver and my cell phone are almost identical in volume. And I actually laid one against the other, and they're almost precisely the same amount of volume. Well, I show that the silver kilo and the phone are basically the same space and same size, and yet one's worth about $100 and the other's worth $1,000. So a cell phone is a high unit for volume item. In other words, you're spending a lot of money for the amount of space that a cell phone takes. In fact, there's very few things that the average person buys that has as much value or as much cost to it as a cell phone for the amount of volume. I mean, razor blades maybe, something along those lines. But the cell phone is 1/10 the value of a bar of silver. So I'd say, is it really that bulky? A laptop computer made out of pure silver, if it was just melted into the volume of a laptop, is probably $10,000. Okay. 8 to 10, depends on the size of the laptop, of course. So I'm trying to make the point. And then I say, look, if you compare it against gold or platinum, sure, it's too bulky. but relative to any other item that the average person owns, it's really not. So that's another one of those, I call it missing the silver market. I mean, most people that invest in the silver markets are probably, and this is a guess, there's no way to know, but probably putting in like $10,000 or so. I mean, that amount of silver, you could pretty easily hide in an apartment or a house or buried in a flower pot or whatever. You start talking $500,000, $1 million in silver. Yeah, you're talking some pretty substantial size, and in those instances, you might consider it to be too bulky.
We are talking to David Morgan on This Week in Money. Let's talk about the price, Dave. Silver trading below $32 as we're talking just about a year ago. Gee, it seems like such a short time ago. It was trading at almost $47. What's behind the drop in silver prices?
Well, a lot of things. One is that the market really did get ahead of itself. About the time a year and a month or so ago, when things were really rocking it up and silver was moving above the $35 level, I was telling anyone that was listening, privately and publicly, in other words, for my paid members and any public domain radio show or blog or whatever, be careful. If you've got to buy it, buy some, don't buy it all. This thing's going parabolic. And as I've said before, I got a lot of flack from the silver community for making those statements. But here we are a year later, and it proves to be the case.
Yeah.
I mean, if you load it up at 35 to 40 or 40 to 45 or even above 45, and some people did, you're not too happy right now. So these markets that get overextended like that and get ahead of themselves, and silver did in April last year, going into the 1st of May. Gold did it in September, not to the level that silver did, but it did it, at least in my opinion, and I said so at the time. It takes a while to back and fill, consolidate, and rebuild a base. And that's what's happening, and people get impatient. They don't like it, but this is the way markets move. And, of course, there's the manipulation situation, and, you know, people look at that, and it does take place. And so they really got frustrated. So, you know, if there was no manipulation, it's my strong opinion, well, we would still see some consolidation in the market. And then silver or gold or both start to get some strength to them. And as soon as they start to build a nice, pretty solid base, they get whacked in the paper markets again, and people really, as I said, repeating myself, they get pretty frustrated.
David, fill us in for a second on the manipulation aspect, because it's not well understood. You're one of the few people who can explain it coherently. What's going on, and how real is the possibility of manipulation?
Well, one is the long-term trend cannot be manipulated. I mean, if that's true, if it could, you know, they could put the price at, you know, the price would still be at $5 for silver. Gold would be still under $300. There's too many market forces that overwhelm even the powers that be over time that take the price higher. Would the price be higher without intervention in the market to manage the price or try to suppress it from time to time? Yes, they would be higher. But the paper markets are what control the price on a day-to-day basis, and it's all based on buying and selling pressure. Mm-hmm. So the market doesn't really care for a very long time if the selling is on paper or the selling is in the physical market. And, of course, in the futures market, that does establish the price both in London and in New York and even in the aftermarkets, which are Hong Kong. You will find a lot of paper trading that sets the price. But, again, it can certainly move the price down, but it can't, keep it there forever. And that's what's been going on time and time again. We just had it recently on the 29th of February where basically 550 million ounces were sold on paper. That's basically two-thirds of an entire year's mining supply. No one is going to sell that much at one time unless for one reason and one reason only. And it could only be one reason, and that's to knock the price down.
Yeah.
So it's unfortunate it happens. It's true of most markets. Silver gets kind of a huge eyeball overlooking it because it's one that's pretty easy to tell when this is happening. And also it's been one that's probably been written about more than any other market for lots of reasons.
David Morgan, our guest here on This Week in Money. And, of course, a one-third drop in the silver price over a year represents, for a lot of folks who are looking forward, a great opportunity in silver. Where do you see the silver opportunity coming up?
Well, first of all, to be patient. I don't think we have much longer to wait. I think we have a few more months. I think we're going to be back, on the positive ground. Probably by the end of the year. I mean, I know I made the statement, and I'll back it up. When I'm wrong, I'm wrong. We don't know if I'm wrong yet or not. I thought we could see 60 by the end of the year. I'm not so sure that's a good forecast. I think we'll be above 40 at least. And I think gold will definitely be above the $2,000 level by the end of the year.
What's driving the silver market?
Well, right now, nothing. It's in a wall. It's moving back and forth, and there isn't really any news or anything that's moving it, because we need new buyers to get it higher, and there aren't any new buyers. There's a little bit of buying by the professionals, but the professionals are smart. They don't buy a big lump at one time, because, as I said a moment ago, if you sell tons and tons of silver on one day, it's going to move the price down substantially. Same thing happens on the buy side. If you buy a ton of tons and tons, buy 550 million ounces on paper in one day, it'll shoot the price, who knows, 10 or 20 bucks. So they accumulate slowly. So they take small positions and feed into the market slowly over time. That is taking place, but it's not enough to move the price yet.
Now, one of the things that you taught me early on is that silver and gold behave differently. Silver, being a more industrial metal, behaves much differently from gold. And the latest we're seeing is that there could be a reduction in silver demand this year. Is that what you're seeing? What kind of information are you seeing about the demand for silver?
Well, just for the paid members only, I put was one of the questions I got from someone in Canada, I believe, about the solar demand going forward, and I explained that solar is still powerful. It's still part of the industrial demand. It's probably not going to be as great as was forecast early on by Jessica Cross of VM Metals when she was working there, and but it's still going to be significant. But it's still very correlated to gold, even though it does have a huge industrial component. It's 84% correlated. Nothing correlates to gold 100%, but gold. So it still moves pretty much with gold, regardless of the inflation, deflation, industrial, non-industrial debate. It still tracks it. So just, objectively, gold and silver move pretty much in tandem. It will have some impact, Phil, but I think it's more perception than reality, because what's going to make both the metals move higher is increased demand for monetary or savings or safe haven purposes.
We're talking to David Morgan here on This Week in Money. We're talking about one of our favorite topics, which is silver. And David, for people who are just starting out in silver, who don't have the kind of expertise or experience that you've had, where do you recommend people start in silver?
Well, I really think that they need to be educated, and I provide a free e-letter for anyone that wants it. And if you just go to the website, silver-investor.com, and go to the bottom of the front page, there is a form. All of it's a first name or last name and an email address. Of course, you have to verify that that's you, and then you'll get the 10 rules of silver investing. And those 10 rules will really keep you out of trouble. I mean, they're designed in a very common sense way, and people read them and say, well, I probably would have done it that way anyway, and maybe they would have been, maybe not. But it really does teach a very easy to understand methodology that will keep you from getting burned either in the stocks or in the metal itself.
One of the things you like, David, is silver coins, and for a good reason. They're pretty easy to handle, right?
Yeah, I mean, it's the lowest unit, and in the event you want to spend them or whatever, you have a bunch of, have 1,000 coins, you got 1,000 different options, whereas if you got a 1,000-ounce bar, you got one option when you sell that one bar. So I really like the smaller denominations for most people.
We talked earlier, David, about the demand for silver. What about production? What's happening in the silver mining industry? What's going on there?
Well, I've been, I try to be as straight shooter and truthful as possible, and I've told not only the members but also from time to time interviews like this that the supply side in mining is pretty significantly robust for silver for the next few years. Some really large mines are coming on board, and this will increase the supply of silver. Now, I don't make excuses. It is what it is. That I do not think will continue past about 2015 or so. Most of the big discoveries that can be made are made. And are we reaching peak silver or not? And I think we probably are within the next 3 or 4 years. But I don't want to be too strong in that statement, just like the solar statement. Things change. There was a time when all we were able to obtain out of the Earth's surface was 325 million ounces of silver on an annual basis. And that was it. And it flatlined on that for decades. So anyone looking at the data would say, well, the most you can get is 325 million ounces a year. Mm-hmm. And they would have been right based on empirical evidence. And then a new mining methodology came into existence where you could actually economically recover gold and silver in much lower grades than ever before. So that blew that premise out of the water, and now we mine about 750 million ounces of silver a year. So something like that could come along as well. I don't see it right now, but I won't rule it out either.
David Morgan at Money Expo, Saturday, April 21st at the Coast Capri in Kelowna. And you can register now at moneyexpo.ca. Dave, give us a real quick sneak preview of what you're going to be talking about.
Well, I'm basically going to be turning it over to the audience. I'm going to be talking about the myths in the silver market and misunderstandings. And I'm going to probably allocate, 10, 15 minutes to some of these. And then I'm going to just take questions from the audience because I'm really there for, education purposes for people that, have a question or something on the economy, on silver, on gold, on the political system, whatever they want. I'll stand up there and take the question. So I think it's a good forum to do that, especially the people in Kelowna. I've been here, I think, 3 times now, and I'm really looking forward to the conference.
David Morgan, our guest. You can find him at silverinvestor.com, home of the Morgan Report. And you can read David's latest thoughts on his blog, silverinvestor.com/blog. You can follow him on Twitter at SilverGuru22 and also check out Dave's YouTube channel, Silver Guru. David Morgan from silverinvestor.com. Thank you, sir.
Phil, my pleasure. Thank you.
Coming up, Paul Van Eeden on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
Paul Van Eeden is president of Cranberry Capital Incorporated. He specializes in mining exploration, and he's online at paulvaneeden.com. Paul, welcome to This Week in Money.
Oh, thank you, Phil.
For our friends who might not have met you before, how did you get involved in natural resources?
I became a stockbroker around 1995 and was offered an opportunity to go work for Rick Rule in San Diego at his firm called Global Resource Investments in 96. And Rick specializes in natural resources and mineral exploration. So that's kind of where I cut my teeth and learned about resources and exploration.
Now, you're specializing in the exploration side of things. Why'd you pick that?
Again, very much a function of my experience. That's what Rick's forte was. And I worked for him for 6 years, during which time I got to know something about mineral exploration and financial markets, particularly as they pertain to mineral exploration. But I was really also fortunate because, for 2 things. One, Rick Rule is a fantastic person to work for. He has had, and I'm sure still has, an absolute open door policy for people who work with him. So Rick was extraordinarily generous with his time and experience, which helped me tremendously. The other thing that happened is that Rick had a guy working for him named Brent Cook. And Brent is a very astute geologist with many decades of experience under his belt. He's seen just about everything everywhere. And I spent a lot of time in the years that I worked for Rick, I spent a lot of time visiting projects in the field with Brent Cook. Brent and I used to travel together a lot, looking at projects. In fact, we still do. And I had 2 great mentors, if you will. I had Rick on the financial side and the business side, and I had Brent on the technical geological side to guide me.
Now, most of us, Paul, looking at mining companies, look at it from a retail investor perspective. Not many of us have the kind of perspective that you've been allowed to have over the years, which is looking at these companies from the inside out, looking at them as exploration companies. What kind of a perspective do you feel that's given you, looking at it from the boots on the ground perspective?
Well, obviously, it's of great benefit to try and do as much work as you can when you analyze investments, particularly if you want to be successful at it. And turn it from a form of gambling into a form of business. And one of the things that Rick taught me very quickly was that you need to really focus on your investments as businesses. Don't think of a stock certificate as a trading card, so that the only thing you know about it is the ticker symbol and the price, because that is just gambling. But if you look at the stock certificate as being as representing fractional ownership of a business, and you then invest some time to get to understand that business, then you can convert that form of gambling into a form of business, in a form of investing. You get much closer to investing as opposed to pure speculation. Mm-hmm. But I have to hasten to add that if you're going to be investing in mineral exploration or in commodities of any kind for that matter, there's always a high degree of speculation that you have to contend with, because there are many variables that are not in our control and not known by us, impossible for us to determine, such as the future metal prices, for example. We cannot determine these, and those are variables that impact our returns. So no matter how much work you do in understanding the business, there's a high degree of speculation in the commodity sector and in mineral exploration in particular.
Paul, when you go to these shows, these resource shows that are going on all the time, one of the first things you notice is that there is a dizzying array of companies, all with a great story to tell. As a retail investor, how can I separate the good guys from the bad guys?
It's hard.
Yeah.
I mean, I'll make no bones about it. It's hard. It's hard for a individual investor coming to the show. It's very hard for me going to the show to distinguish the good from the bad. One of the things that helps me tremendously is my network of contacts. Obviously at the top of the list would be Rick and Brent, mm-hmm. but the top of the list doesn't stop with Rick and Brent. I have a group of brokers in Canada that I work with who are fantastic contacts and sources of information, and I have geologists that I've got to know over the years. I'm on the board of 2 mineral exploration companies, and so I have people whom I can call on for assistance, whom I've met through those board positions and through the management positions in those companies. And I've tried to conduct my business in a way that over the years as an investor, I've got to know the management of companies. And in most cases, I have befriended many of those people, and I can still call on them. And that, by the way, is something that anyone can do. That's not unique to my position. If an individual investor takes the time and makes the effort to go to some of these conferences, one of the things they'll notice is that in most cases, the president or the CEO is present at the conference. Mm-hmm. And don't be shy. Walk up to the guy, introduce yourself, and talk to him. That's what he's there for. I mean, these guys fly thousands of miles to be at the conferences to talk to individual investors. So an individual investor should go talk to them. And if you talk to these guys often enough, particularly if you frequent these conferences over many years, you'll find the same CEOs are at the same conferences year over year, and they're at different conferences throughout the year. So anybody has the opportunity to get to know people in the industry at the CEO and the vice president of exploration level. And the better you get to know these people, the better you will understand their businesses, and the more information you'll be able to get from them with regards to the industry in general, all of which are things that will help you make decisions and become a more successful investor.
We're talking to Paul Van Eeden here on This Week in Money. Paul, the gold price today making headlines, not because it's going anywhere huge, but it has overtaken the price of platinum. Is that significant for you? Does that really mean anything?
No, I don't think that means anything at all.
Okay.
I mean, there was a time, 10, 15 years ago when gold was ahead of platinum. Then platinum got ahead of gold, not gold ahead of platinum. I mean, I don't really think it makes any difference. If you're driving down the freeway to work in the morning and the car in the middle lane overtakes you, does it really mean anything?
Only for the guy driving the other car, and only for a short time, I would think.
Well, and there's the key, only for a short time. And really, it's of no significance. I mean, the fact that the guy in the middle lane overtook you doesn't mean that his car is faster than yours, more expensive than yours, better built than yours. It meant that lane is going a little faster than yours at the moment.
Sure.
Gold is a little higher than platinum right now, and maybe a year from now, platinum will be higher than gold. Maybe not. Fundamentally, it makes absolutely no difference.
Paul, what's your perspective on the gold price? Where do you see gold going, and what are the fundamentals driving the market?
No, I see the gold price going lower, in fact.
Okay.
And I think there are two drivers to that. I think that a lot of the fear in the market that drove the gold price up to its record highs of approximately $1,900 an ounce were fears of future inflation. And I think those fears were for most part misplaced. And as that fear subsides, I think the gold price is going to be trending downwards. And I mean trending down against almost all currencies. I say almost all currencies because there will always be aberrations, currencies that devalue against gold and against other currencies. So the first driver for lower gold prices, I think, is subduing the fear of future inflation. The second thing that I think is going to drive gold prices down is a stronger U.S. dollar. Because gold is priced in U.S. dollars, if the U.S. dollar gains on foreign exchange markets against other currencies, the price of gold in U.S. dollars declines. And I think that we are entering a period of time in which the trend for the U.S. dollar is more likely to be up than down.
We are talking to Paul Van Eeden here on This Week in Money. Over at the TSX, Paul, gold miners continuing to recover after a couple of brutal weeks. The miners have been trading at a discount to the gold price for quite some time, as long as back as I can remember. Do you see any signs of this trend reversing?
I think it's a trend that will reverse over time, but I think the way that the trend is going to reverse is the gold price is going to come down, the mining stocks are going to go down further, and eventually you'll get a shift in psychology when the outlook is going to become more bullish and the stocks will trade at a premium to the gold price. So what I think is happening here is that the stocks are actually leading the gold price lower.
What's the psychology among the explorers that you talk to? How are they feeling about the exploration business? How are they feeling about the price of gold? How are they feeling about mining conditions generally?
Well, it depends on who you talk to.
Sure.
That's a very general question, and I don't presume to be able to answer that question on behalf of the industry. What I can tell you is that I think from my own personal perspective, so this is my opinion only, that things are going to get tougher for the mineral exploration sector. I think that junior exploration companies are going to find that money is harder to come by. Their valuations are going to go down lower than what they are now. Financings are going to become more and more difficult and tougher. So I think that the junior exploration industry is in for another few years of an extraordinarily tough market. But I will add to that as an investor, that is a good thing, because it means that I can buy businesses at a lower valuation now than what I could 3-4 years ago, and I believe that I'm going to be able to buy businesses, mineral exploration businesses, even cheaper in the future, in the next 2 years, than what they're trading now. So as an investor, it doesn't concern me that much that things are going to be tough. As the director of two mineral exploration companies, it's of great concern because our businesses are going to have a tough time financing. So we have to plan for a tough market when we put on our corporate hats, and we have to participate in tough markets when we put on our investors' hats. Because, you want to buy low so you can sell high. Well, this is the time to buy low. And I think the time to buy, the time for us, the time period in which we can buy low is going to extend for a while into the future yet. So good time for people to buy stocks. But again, quickly hasten to add, I am a very patient and long-term investor. So I am buying stocks today that I think I will own for 5 or more years. I'm not buying stocks today that I think I'm going to trade out in 18 months at a profit. I'm a very, very long-term investor.
We're talking to Paul Van Eeden on This Week in Money. And the elephant in the room here, Paul, China, new analysis from the World Bank. China's economy slowing, but they're hoping for a soft landing there. Whatever happens, how's that going to affect demand for commodities and commodity prices, do you think?
So I think the Chinese economy is going to continue to slow down for a while. And, it's very hard. I don't want to sit here and tell you that I don't believe the numbers coming out of China, but But I can tell you that I think that the Chinese economy has structural problems that are going to become very difficult to sustain over the long term. So I think that China is going to slow down, and I think it's good that the Chinese economy slows down. They've got some issues to work out before sustained growth will continue. That should affect commodity prices, and in fact, I believe it already has affected commodity prices. If you look at the base metal complex, excluding copper, so let's look, for example, at aluminum, lead, and zinc. Those prices peaked around 2007, 2008, and they've come down quite substantially, despite the rally between, that occurred around 2009 and 2010. 2011 was not an easy year for those commodities. The exception to that, of course, is copper, which has had a stronger run than the three base metals I mentioned prior. But even copper, I believe, is now softening and weakening. And we've also seen iron ore and coal prices starting to show signs of softness. So I think that the slowdown in China is affecting commodity prices. I think it will continue to affect commodity prices, and fundamentally should cause the commodity complex to be soft for perhaps this year and a couple more years to come.
Paul, you have a couple of appearances upcoming for folks who would like to see you and meet you. Where are you going to be in the next little while?
Yes, Phil, thanks for asking. I am speaking in the end of this month. It's the end of April and the first 2 days of May in Toronto at the conference being put on jointly by Sprott Inc. actually, and the Agora Financial people. So it's the Sprott Agora conference in Toronto at the end of this month. And then in May, I believe it's the 13th and 14th of May, I'll be in New York for the Hard Assets Conference in New York, put on by International Investment Conferences.
Paul Van Eeden is president of Cranberry Capital Incorporated. He specializes in mining exploration, and he's online at paulvaneeden.com. Paul, thank you for your time. We appreciate it.
My pleasure. Thanks, Phil.
After the break, Ross Clark on This Week in Money.
It's all about money at the HowStreet.com Money Expo 2012. See Silver Guru David Morgan, Ross Clark on technical analysis, Keith Schaefer on oil and gas. Also video with Sean Broderick on small caps, money manager Danielle Park, and Dr. Doom Mark Faber interviewed by Danielle Park. Plus visit with industry exhibitors. The HowStreet.com Money Expo 2012 at the Coast Capri Hotel in Kelowna, Saturday, April 21st. To attend free, pre-register now at moneyexpo.ca. That's moneyexpo.ca or at the door. It's all about money.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at TalkDigitalNetwork.com.
It's always good to have Ross Clark with CIBC Wood Gundy in Vancouver with us. Ross is at Money Expo, Saturday, April 21st at the Coast Capri in Kelowna. You can register now at moneyexpo.ca. Ross, market's looking a whole lot like that North Korean rocket launch today. A great start, but a bad ending.
And a very short-lived trip. And this is exactly what we've had in the equity markets. We got pretty hard break here for a couple of days. The markets got oversold and got that exceptional bounce yesterday, but no follow-through so far.
Most of the bad news coming from China. Their economy, they're growing less than expected in the first quarter, and that's obviously affecting things.
If you're measuring in decimal points, correct?
Mm-hmm, yes.
Yes. 1/10 of a point is something that becomes questionable, but clearly the Chinese economy seems to have at least plateaued at this point for now.
So give us a picture of what's going on with the technical structure of the major markets.
Okay, well, if we take a look, just finishing off, say, with, China, and when you start to see things calming down there, then you take a look over at the industrial commodities and you see the price of copper, which topped out the better part of, 2 months ago, and is now rolling over. It's has four times. I guess we tried to get through 395, and copper couldn't do that. Now breaking through support, we're trading into the mid 360s, and this is part of a normal sort of seasonal trade that we would see in the copper market. Weakness in April right through into June. And as we know, quote, the PhD in copper prices related to the economy and the S&P, that fits part and parcel with what we've been looking at for the general equity markets.
Copper got to be affected by what's going on in China, right?
Oh yeah. It's part of that. And you've got our momentum peaks in terms of the equity markets happened in late February, first week of March. We did get some minor price highs in the U.S. markets, and in particular the NASDAQ, as we moved through March to the first week of April. But Canadian market, resource oriented, has been a heavy area here, and it's part of the sort of the game plan for the year here was we'd put in that high in the first couple of months of the year, roll down in, put in a spring low. Still don't see any change here in plans. Looking for basically an 8 to 10% haircut in the markets from the highs in terms of the U.S. market. So the S&P, which sits in the mid 1360s at this point, probably looking at support in the 1290 to 1310 range, and if we could do that in the next, call it 6 to maybe 12 weeks, that would be very appropriate right now.
We had some good news in the markets this week. J.P. Morgan Chase and Wells Fargo both beating expectations. And Google, how about this company? Making $3 billion in the first quarter, up 60% from a year earlier. So, of course, the stock had to fall $3.
Oh, yeah. Nothing like beating expectations and then the market's still not even liking it. It's going to be interesting to see how the big one out of the group here, Apple, performs when its earnings come out in the next week or so.
Ross Clark from CIBC Wood Gundy, our guest on This Week in Money. Let's talk about currencies. The dollar index heading for 80 after a peak in the high 70s yesterday, and it is the dollar is strong, boy.
Dollar is strong, and we had been experiencing the all-one market phenomena for most of last year and the early part of this year. Then markets and sectors started to break apart, doing their own thing. But we seem to, in the last week or so, be back into the all-one market scenario where the action that you've had in the U.S. dollar this week has been part and parcel. We've seen the inverse going on in the equities and in the other commodities. It's to look at it realistically, the dollar is still range bound. If anything, it's tweezering in on itself. The rallies, we had a 1.25 rally on the dollar index at the tail end of March. We gave up maybe 2/3 of that into yesterday. Now we've bounced back, but it's still in this tight consolidation. Our view is that the uptrend in the dollar, which started almost a year ago now, I mean, it was the 2nd of May last year, that is still in force, even though we're having this pause that has been since the second week of January. I think that this thing is still going to resolve on the upside, and the index, which sits at 80 right now, we realistically think that a target of around 83 would be foreseeable probably as we move into the spring and as other markets see some vulnerability.
Ross, we got some excitement in the bond market. Yields on U.S. 10-year notes down below 2% again. In Europe, just the opposite. Spain up to almost 6%, and Italy back over 5.5%.
Yeah, back at 5.5%. Yeah. And the equity markets over there coming under pressure again. It just seems, you get Greece out of the way, and then the other names that had always been just on the back burner have come forward. Clearly, the problems that they have there have not gone away. There is a contagion. There is a situation that is going to grow over time, and analysts that I follow basically see that this European situation will continue to grow, and it will then move over the next few years to other countries.
More with Ross Clark next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We are back with Ross Clark. And Ross, this week, gold slumping to 1660, wiping out most of the week's gains. Starting out strong thanks to some happy talk from the Fed. I guess here that the stronger U.S. dollar is a big factor.
Oh, yeah. And, once again, there's statements from the Fed. We just go week by week or even within the week with, is the economy slowing enough that we need a QE3, yes or no? It's back and forth. And so we're stuck still in this trading range. The key support that I've been looking at was the 16 and a quarter. That area represents a 61% retracement of the rally that we had from the September low last year into the highs here. So we continue to view that as a fairly important level. Also, looking at the gold-silver ratio, which it's a shame we don't have some charts. We could present these to people. Actually, this is one of the ones I will have next weekend when I'm in Kelowna.
Okay.
We'll show them a number of things that will be to help clarify the overall picture for people. But the silver to gold became overbought into the most recent rally a couple of weeks ago. It's in no man's land right now. The modeling that I've been working with on the precious metals was that following the late February, first week of March high, that we would have an end of March low, which came a few days late, and we should have another secondary low and one of really good significance out in late May or first couple of weeks of June. And the manner in which we move from here to there, that next 6 weeks or so, will be very important. If we can hold in this 16 and a quarter, 1650 level on gold and manage to turn the corner, I think we can have an exceptionally good move in terms of the metals. Now, in terms of the stocks, the related stocks, when we look at the ratio of the XAU, so these are the mining stocks related to either the S&P or we look at them related to gold, we can see that they are exceptionally low. And as a matter of fact, if we take a look at the relative strength index on the XAU to gold ratio, it's the fifth lowest level that we've had in almost 100 years. Wow. The last time that was down in this level was into the 2008 bottom. And prior to that, you have to go back into the 1940s to find levels that are this extreme. So from a valuation perspective, the stocks are getting very, very cheap. It can take the better part of anywhere up to maybe 2 more months to put in the bottom and get the turn when we look back at these historicals. But once the reversal happens, it can be very, very significant.
Interesting piece in the Wall Street Journal today. Gold miners, the new gold. And here's Dennis Gartman saying, for the first time in a very, very long while, gold shares are actually outperforming gold itself. That must have been a while ago because the 1-year figures with the GDX and the GDXJ are way down there.
Yeah, I think Dennis might have actually been looking at an hourly chart.
Well, it's interesting. When you look at the figures from a year ago, the GDX down 22%, the GDXJ, the junior index, down 42%. That's a big drop.
Oh, yeah. These are sizable moves, but you have to recognize, too, I mean, these indexes, these mining indices, do move around a lot. There's a lot of volatility in them. The percentage moves off the bottoms are very large. But there's no doubt in anybody's mind that since December of 2010 that the mining stocks have been underperforming dramatically against the bullion. And my theory on this was that because you have so many alternative vehicles these days sitting out there for investors when they're looking at the bullion itself, and they don't it used to be that you either bought the physical or you bought a futures contract, and then you had all that leverage that came into play. And now, and other than that, you went out and bought individual mining companies. Well, nowadays there are so many exchange-traded funds that relate specifically to the bullion that I think that's attracted a lot of the money away from the miners. But from a valuation point of view, these stocks eventually get cheap enough relative to their cash flows that when the next major floor is put in the gold price, and this is the way I look at it, and the way that the market performed in 1979, 1980. When you put it in the new floor, let's say it was 1535 in the last 6 months, and we go through 1900. That 1535, once it is then perceived as being the floor rather than the 680 low that we put in 2008, then I think you will see these stocks make the major catch-up. But there's a lot of pain in the meantime, and until then, I think it's a matter of watching the technicals, see if you get more than just the single bounce that Gartman has talked about here in terms of outperformance. If we can see the stocks start to hold on a relative basis around an important low, and being that the equity market as a whole is into a seasonally unfavorable period from here into June, July, if we can get this stretch out of our way and start to see upside bias, then I think you've got the chance for the more sustained catch-up from the stocks.
You can see Ross Clark at Money Expo, Saturday, April 21st in Kelowna. Register now at moneyexpo.ca. Ross, what are you going to be covering at the show?
Oh, we will touch everything from the long-term secular bull and bear market scenario that we're into right now, through interest rates. We will talk about the gold and precious metals, give people the outlook in terms of where we are and some of the things to look for. Specifically, then we will look at also the copper market. There's a lot of things on the table here. My problem is going to be narrowing it down so that we can not run over our time allotment.
You want to get a hold of Ross? It's ross.clark@cibc.ca, and if you want to call, it's 604-661-7759 or toll free 877-331-5122. Ross, take care of yourself. Have a good weekend.
Thank you, Phil.
Our thanks to our guests, David Morgan, Paul Van Eeden, and Ross Clark. And thanks to you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.